Hello and welcome. My name is Melissa Galasso, and I'm excited to be with you today to talk about our most recent GASB number 94. I can't believe we've already hit 94. I think this is, time is just flying by. This was issued in April of 2020, and we are referring to this as the P3 or Triple P project. It was originally called Triple P or PPP until PPP had a whole new name and whole new just recognition with COVID-19. And so when they issued the standard, instead of referring to it as Triple P or PPP, they called it P3. And I think that has a lot to do with COVID-19. So GASB 94 was issued in April, and it addresses a gap in GAAP. And I know that's kind of funny, but really what they found here was when they were looking at service concession arrangements, which were in the scope of topic, or in the scope of Statement 60, and then they looked at GASB 87, what they found was that there was some lack of guidance for items that were not quite service concession arrangements, not quite leases, and we didn't know exactly how to treat them. So what is a Triple P? A Triple P is an arrangement in which a government, the transferor, contracts with an operator to provide public services by conveying control of the right to use or operate a non-financial asset, such as an infrastructure or other capital asset, the underlying Triple P, for a period of time in an exchange or exchange-like transaction. So here you can see that we have an operator and they have the right to operate or use. All right, so that's one of those key items, and that includes infrastructure assets or other capital assets. Within a Triple P, we have something called a service concession arrangement. And a service concession arrangement is a Triple P arrangement between a transferor and an operator where we have certain additional requirements. So we have to first be a Triple P, but then the transferor conveys to the operator the right and related obligation to provide public service through the use and operation of an underlying Triple P asset in exchange for significant consideration, whether that be an upfront payment, installment payment, a new facility, or improvements. Through this, the operator collects and is compensated by third parties. So a great example of this would be a toll road, right? So the entity is going to pay the government some type of upfront payment or installment payment, and then the operator is going to be paid by these fees from third parties. The key here is that the transferor is going to determine or have the ability to modify or approve the services and the price or rates that can be charged. And that's where the limitation is. And those are areas where we don't meet those requirements, where the transferor does not set the price or rate. We really didn't have accounting for that because there was sort of that expectation that the service concession arrangement always had that. So that's why we have a more broad definition of a Triple P. In addition, the transferor is entitled to significant residual value or interest in the service utility of the Triple P at the end of the arrangement. So if it's a toll road, the government obviously gets the toll road back at the end. GASB 94 also introduces this concept of an APA. An APA is an arrangement in which a government compensates an operator for activities that include designing, constructing, financing, maintaining, or operating an underlying non-financial asset for a period of time in an exchange or exchange-like transactions. So this is based entirely on the asset's availability for use rather than on the tolls or fees. So it's not based on usage, it's based on availability. And availability for use can be based on physical condition, construction milestones if we're building it, or certain availability measures. So in an APA, a government procures a capital asset or service rather than receiving compensation to allow another entity to provide the public service. So there are some nuanced differences between a Triple P and an APA. An APA may be similar to a Triple P that includes variable payment provision. However, in contrast to a Triple P, the other party to an APA is receiving compensation from the government based entirely on availability, not the actual performance of the public service. So again, not being paid by those third-party drivers. So as a result, GASB 94 will supersede GASB 60, which is reporting for service concession arrangements, and instead provides new guidance. So if we have a triple P that meets the definition of a lease, we're going to apply the accounting reporting guidance in 87, which is lease accounting. If the existing assets of the transfer are the only underlying triple P asset, improvements are not required to be made, and the triple P does not meet the definition of a service concession arrangement. So long as we don't have any of those three, then we're going to use lease accounting. For everyone else, where we don't meet the definition of a lease, we're going to use accounting similar to GASB 87. So let's think a little bit about triple P accounting here. We're going to start with the transferor, which is always going to be a governmental entity. If an underlying triple P asset is an existing asset of the transferor, at commencement, the transferor is going to continue to report the underlying triple P asset. So even though the other entity is going to have that opportunity to operate it or to use it, we're going to continue to list the triple P asset on the transferor's books. If the underlying triple P is a new asset purchased or constructed by the operator, then the transfer is initially going to measure the underlying triple P at acquisition value when the asset is placed into service. However, if the triple P arrangement requires the operator to return the triple P arrangement in its original condition, then we're going to have even more unique accounting there. So again, lots of little rules here. So accounting for triple Ps at commencement, we're going to recognize a receivable for any installment payments that are going to be made, and then a deferred inflow of resources. So you can kind of see where this accounting looks very much like lessor accounting, right? So we have our receivable and our deferred inflow. If the underlying triple P asset is a new asset purchased or constructed by the operator and it meets the definition of a service concession arrangement, then the asset purchased or constructed underlying the triple P asset is measured at acquisition value when the asset's placed into service, and that at commencement, the receivable for payments and a deferred inflow of resources. And again, they're going to continue to report the underlying triple P asset. If the underlying triple P asset is a new asset purchased or constructed and does not meet the definition of a service concession arrangement, when the underlying triple P asset is placed into service, we're going to recognize a receivable for the asset purchased or constructed to be received by the operator, a receivable for the installment payment, and then that deferred inflow of resources. So again, in this scenario, when the underlying triple P is placed into service, then the transferor is going to recognize that receivable back. Any initial direct costs incurred by the transferor are going to be reported as an outflow of resource or an expense. For improvements, a transferor is going to measure improvements made by the operator to the underlying asset at acquisition value when the improvements are placed into service, and we're going to typically follow the same rules as you would for any other asset, including depreciation or impairment. On the operator side, assuming it's governmental, if it's not a governmental operator, then they are going to follow FASB GAAP, and FASB has service concession arrangement guidance. However, if it is the operator is a governmental entity, then we need to provide guidance under GASB. So if the underlying triple P asset is an existing asset of the transferor, at commencement, the government operator is going to recognize a liability for payments and that intangible right to use asset. Again, very heavily relying on lease accounting. If the underlying triple P accounting is a new asset purchased or constructed by the operator and it meets the definition of a service concession arrangement, again, you're going to have the liability and the right to use asset. And then if the underlying triple P asset is a new asset purchased or constructed but does not meet the definition of a service concession arrangement, then the operator is going to recognize the underlying asset until it's transferred to the operator and continue to apply whatever guidance would be appropriate for that asset, including depreciation and impairment. However, when the asset is placed into service, then they're going to recognize a liability for the underlying asset to be transferred to the transferor, as well as a liability for the installment payments and then the deferred outflow of resources to be transferred to the transferor. If the at transfer of ownership, if the operator is required to transfer the underlying triple P asset to the transferor during or at the end of the triple P term, then the operator should measure the liability based on the estimated carrying amount as of the expected date of transfer and recognize a deferred inflow of resources equal to the estimated carrying value of the underlying triple P asset as of the expected data transfer. And then they're going to subsequently recognize a deferred outflow of resources as an outflow of resources, so no longer deferred, straight line method. Other accounting that's similar to leases How do you calculate the term? We're going to use that same concept of consideration of whether it's reasonably certain for options as well as options to terminate, whether they are at the transfer or the operator consideration. The calculation of your receivable and your deferred inflow of resources, as well as your right of use asset and your liability. The accounting is actually very, very similar in terms of what's included, right? The present value of the payments that you expect to either pay or receive, and then the adjustments for payments made at or before commencement. So very, very similar accounting here for those types of items. APAs, on the other hand, are a little different. So an APA typically can have multiple components. So we might have a variety of different items. So if we have construction, design, etc., we need to think about how we're going to be paid, right? So it could be a fixed payment or it could be a variable payment. So each component is going to be its own arrangement. Components that are related to design, construction, or financing of a non-financial asset are going to, in which ownership transfers to the government by the end of the contract, are reported as finance purchases by the government of the underlying non-financial asset. On the other hand, if it's related to providing service for the operation or maintenance of the non-financial asset, then it's going to just be an expense by the government related to the payments that they are making. So when is this effective? Well, originally it was planning for 2020, for fiscal year beginning after 2021. However, due to COVID-19, GASB 94 was finalized during the COVID-19 period, and so they already included a delay. So they did not have to include that in the exposure draft that they put out there, because when they were doing their final deliberations, they added that extra year already in here. So it's for fiscal years beginning after June 15, 2022, and all reporting periods thereafter. PPPs should be recognized and measured using the facts and circumstances that exist at the beginning of the period as you go through it. So I know that was a lot of material. This is a very long standard. It's about the length of the Leases standard with a little bit more to it. It covers things like remeasurement and changes in terms and things of that nature. So this is a high-level overview. It is not a replacement for taking a full-length GASB update. Thank you so much for joining me. Hope to see you on a future Nano Learning.